Hi folks, this is Hyman, and I want to talk to you today about trading the 10-week SMA. So it's 10 weeks, so we're on a weekly chart, and it's the simple moving average. Now, a lot of times people wonder whether they should be biased to the long side or the short side. And this you'll notice this SMA, even though it's a very short period SMA, being a 10 period, it doesn't change direction very often. So we're looking at a 3-year chart, and you see 1, 2, 3, 4, 5, 6, 7, 8, about 8 changes in 3 years. And so my point is that it helps to keep you on the right side of the trade more times than not, and not get whipsawed out by the little gyrations that are back and forth. Now, it doesn't mean you necessarily have to enter by using this moving average, but you can get your sense of direction as to whether you're better off looking for buy trades or short trades by using it. And so you can see here where you should be biased towards long trades, and then here biased towards short trades. Now, any trend following method, here's how that's going to work. You're going to get the meat out of the middle, which is the very, the bulk of the trend, 50%, 75% of the trend. What you're not likely to get is the front and the back of it, in other words, the top and the bottom. Why is that? Because when the pair is making this transition, like right in here, it would you would still be told to be long, yet it would switch to short. Yet it takes a couple of candles or so to start turning down lower. So there's a couple of 2 or 3 weeks in there at transitional points, which again happen about 8 times out of 3 years. That will be a little choppy, and then of course you're going to see these huge runs, these huge gains that are to be had, and that's where you more than make up for the turning points that happen here. Once again, you go through another turning point here. Takes a couple of 2 or 3 candles to get turned around, but then you've got your overall trend direction. And even though there's gyrations up and down and all over the place, to still stick with the looking for having a bias, a buying bias, because of how the moving average is sloping up. So and these stay in effect for a good while. So it gives you some steadiness, some consistency. It gives you something that tells you what the bias is for usually months at a time minimally. And so you can see right now on this euro dollar weekly 3-year chart that that the bias is still downward at this point. And remember, there will come a point where this will come up. It'll take a few weeks to transition, and then there will be an uptrend whenever this does make its turn. I'm not saying it's about to do it now. I'm just saying when it does make that turn, that's typically what will happen. And so, when it starts to come above the moving average, so in other words, like let's take this example. Pair goes down here, the pair closes a week above the moving average. You would want to take your profits from this run here because you're in this transitionary period. You want to see if this thing just kind of overshoots and comes back over and everything stays headed downward, or if it's curling and going to turn up. At a couple weeks later, you know that. By the time you get to about this candle here, you've got this distinctly turned up, and the new trend is upward. So any pullback that happens like the spike low here, you can buy and trade it up. When it falls back and starts to loop around again, you can buy and trade it up. So you don't necessarily have to be eternally long just because the moving average is up. You can trade it in the short term. You can look for daily buy signals. You can look for 4-hour buy signals, whatever, hourly chart buy signals, whatever you're looking. But you at least your overall bias. So right here with this pointed distinctly downward, that you're better off looking for short trades than long trades, no matter what trade or time frame that you enter that on. If that's hourly, 4-hour, daily, whatever, that your bias is should be to the downside. So it's good about letting you know which direction you should be biased towards, and you'll gain more of an edge by using a tool like this over time. And that's all you need is a statistical advantage over time. I just wrote an article for Currency Capitalist that you ought to look at currencycapitalist.com, and it'll be posting in the upcoming days, and it's about having an edge, and you can there's several times throughout the years that I've talked about having a statistical edge in your trading, because sometimes people will give up on a system if they have a couple of losers in the short term or something like that. But what you have to do is analyze any indicator, whether it's moving average, a slow stochastics, whatever. Look back over a year or two of trades and see, did it have that statistical edge. If it did, then trust it through the choppy times, knowing that the good times will reemerge, that will more than compensate for the times where you were shaken out or stopped out of trades. Because every indicator will have its strength and weakness point. Moving average, the weakness is in the turns. So right here you would have a little bit of a tough time. Not to say that there wouldn't be some winning trades in it, but as it transitions here and then it makes another quick turn and transitions here. So those don't happen real often. You can see it's happened basically twice in 3 years. And so, more times than not, you're going to have long periods right here, here, long period here, long period here, long period down here, etc. So you're probably spending 75% or more of the chart in a distinct up or down trend and not in one of the turning points. So, and you're in one of the turning points, don't give up on a moving average strategy. Just know that, in the upcoming candles, it'll pick a direction distinctly, and then you're back on the winning track, and you're more than making up for any setback that you took in the turn using the moving average strategy. Hey, thanks so much for watching. Bye bye.